quick video. We're back Monday, starting the week off with a video. I just want to come and talk about the different types of liquidity that we have in the market. Now, there's only two. However, if you do not get the right, if you don't realize the reasoning behind each, you're not gonna get what you want off of it, if that makes sense. So we'll make a little diagram here. Two types of liquidity. I can't move it. You've got internal and external. Now if we was to draw this, it would look something like this. Now this would be your external, this would be your internal. Now the different types of lows that we have, say we've got these marked up. Let's say we then come to here. If we then have our chart, let's say this is 930, say that's 930, okay, that's 930, and we've seen manipulation into here. Would we then expect a full reversal off that? No. Why not? Because what this internal low would be used for would be for retracements, and external you could then seek reversals. So let's say 930, come down, come to here. Where's price likely to head to? Is it going to be here? Why is it just doing that? Is it going to be here? Is it going to be here? Or is it going to be here? Now this, would it make sense? Would we expect a full reversal off of an internal low? No, can't be that. Would we expect no reaction off of an internal low? Then, unless we've got news and this move lower is news, no. So why would we expect here? What can we see? Use as a retrace into here. So we could have a bullish bias until we get to here, and then as soon as we're in there, we could have a low risk sell. But ideally you want to be taking the trades that are from external to the reversal point. So let's now say we move to the external low, and I mean, we probably, if this is 930, you probably wouldn't see a full reversal off, because the full reversal off, well, would have been this, wouldn't it? This external high. But we could still, where would we then likely to see price go? Let me move this up. We was here. And it's not 930. Let's say it's 1050 macro. and then we take the external low, what would we then expect? Well, price to move minimum to here. If not, we could see a turtle soup here, just because time is not aligned with price, because the time of the day is important. So 9:30, we take out this external, move lower, can have a bullish bias off this external low, expect a retrace, then a bearish bias to here for the end of the day target. However, if this was the opposite, this was like this, if 9:30 opened up, take out this external low, not external, internal low, because you're within this external range, would we then see a full reversal? No. And these are why half the trades that you enter in long off of these lows, you go into profit and then you get stopped out. Why do you think you get stopped out? Because price is likely to come up, rebalance, and move. Let's say this is 950 macro now. Now, the higher probability move of the day, macro, we're in an external low. Time of the day is set that this could be low of day. And then obviously you want confirmation, like, I don't know, maybe an inverse gap, tapping into an order block, tapping into fair value gap, whatever. That would be the higher probable move. So stop expecting reversals off of internal lows. Just expect retracements. Now, if you was bullish from this low, and we come to this external low, why don't you wait for the sweep, get in here, low risk short. If your drawing liquidity is correct, low risk short to your drawing liquidity. Then from this drawing liquidity, you could then see your big move. Does that make sense? So we're going to show a chart example now. So yeah, the main point is remember what types of liquidity are used for, and make sure you're not patterning it. Okay, so if we look at this example, this is an external low here. This would be an internal low, internal high, but obviously we've opened and dropped lower. So we've taken out an external low. We've also got SMT, which is a good confluence. We've got SMT between the external lows. What did we then do? We then saw, okay, 8:30 got SMT with the external low. This is what I mean by like internal lows. So would we expect a full reversal off of this low? No. At best, we got a small retracement a little bit higher. That's it. Wouldn't expect a full reversal of that low. But yeah, we got this SMT. Then you can start stacking your confluences. So here we've got this inverse gap, we've got this proportion block, we've got this inverse gap as well. This is 9:30. What does 9:30 tap into? This inverse, this proportion block, and then 1 minute. I then got on off of this displacement candle here, tapping into these 5-minute confluences with the narrative of external to internal, and also some extra source. Standard deviations. How would you use standard deviations here? Where is the manipulation leg? It's from this body, this wick high, to this wick low. It's 2 candles. So if it was this candle and that candle, I'd mark it from here to there. here to there. What does it line up with? Well, 2.5 lines up with this liquidity, this internal high. 3 lines up with this internal high. And what does 4 do? Lines up with this lower time frame external high. So yeah, 2 types of liquidity: internal for retracements, external for reversals. Keep that in mind when you're trading. I'm gonna nick that. But yeah, hopefully you enjoyed the video. I'll see you guys in a bit, and peace.